When you kind of think about it from that perspective, and the Fed is again enabling this incredible amount of spending and debt to take place, it's only a matter of time until this thing breaks. The only thing you know for sure, to use that old line, is that nothing's for sure. The best that we can do is try to have as much exposure to as many unknowable futures as possible.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs. Excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. Call me directly at 419-819-9209 or my sons and fellow brokers at 310-562-6400 or 419-490-5295 or email us kaiser@milesfranklin.com.
Welcome back to a Liberty in Finance interview. I'm your host, Elijah K. Johnson, and with us today is Michael Gayed, Portfolio Manager of ATEC Funds at Toroso. Michael, thank you so much for joining us today.
Yeah, my pleasure, Elijah. Thank you.
Definitely. Now, we wanted to have you on because you have such an amazing perspective on really the macro view when it comes to inflation, deflation, the stock market, and also commodities. Right now, if we wanted to start out on commodities, you've really said commodities are undervalued right now. And I know I've talked to, for example, Tavi Costa from Crescat Capital, and he's pointed out how compared to stocks, commodities are at about a 50-year low. What is your perspective on the commodity markets right now?
Yeah, no, I'm a big fan of Tavi, so he does some great work. So a few things. So I think most of the studies, when you look at commodities and they argue that they're cheap, they're looking at commodities relative to equities, right? Sort of the ratio between the two. And it's still at multi-decade lows, right? So if the argument is that there are cycles and that some asset classes become the new winners, well, then if this commodity move is real, it's probably still very, very early. And I think there's a lot of fundamental underpinnings for that, aside from COVID and sort of the supply disruptions everyone knows about. Look, infrastructure spending is coming. It's not just in the U.S., it's going to be global. There's a lot of work that has to be done on bridges, roads, and things that are resource material intensive. So I do suspect there's going to be this sort of broader tailwind that benefits commodities. And again, given that commodities haven't done really anything for a long time, certainly relative to equities, from an asset allocation perspective, it makes sense that you would see some ongoing flows to there. But I suspect it's going to be bumpy. And the reason I'm saying is that it's bumpy is that commodities are notorious for having these sort of, broad boom and bust cycles where prices get very high, they get out of whack. The cure to price is high price, meaning that, more supply comes on and or demand starts lessening, and that brings price down until another wave higher. So you're going to have some of these kind of boom and bust cycles, I think, within the broader secular argument for commodities. And I think that's just important for investors to recognize, because in a world where people are increasingly myopic, having sort of a longer term view, recognizing that that's coming is going to be what keeps you in the game.
Now, when it comes to the precious metal markets, I know you've said before how really a lot of people see gold as an inflation hedge. But you've pointed out how it's not as so much an inflation hedge as more it responds to volatility and risk. And this was from an interview on Kitco, you were mentioning this. Can you expand on your position regarding gold?
Yeah, so look, I think a lot of people get gold wrong, perhaps for the best of intentions, right? So first of all, what is gold in a portfolio? It's a diversifier, right? Meaning it doesn't really correlate to equities, doesn't really correlate to bonds. So from that standpoint, if you are truly trying to diversify, you probably want to have some portion, some allocation towards gold. Some people will argue that gold is an inflation hedge. Some will argue it's a deflation hedge. Some will say it moves with the dollar. Some will say it doesn't. When you look at gold relative to any swath of different macroeconomic variables, gold really doesn't correlate to very much. What it does tend to historically correlate to in the very short term are these risk-off pulses in the stock market, where volatility for a moment in time bursts. Money goes into the safety trade of treasuries and gold, and then it kind of peters out after the volatility is done, which also is why, again, it tends to be a pretty good diversifier and hedge when you need it the most in those risk-off periods. It's hard, I think, to make the case that gold is, the often cited store of value that people would argue it is. Certainly, it's done very well for many, many, many decades and centuries, and because of its historical place as a form of money. But you have to be careful, right? Because gold really hasn't done anything for the last decade. Now, the next decade could be very different, right? But if you view it more as an investment, as an allocation, as opposed to a store of wealth, as opposed to something that correlates to inflation when it doesn't, that helps you figure out better sizing. And I think, again, helps you manage your own expectations as far as how that path of gold returns might look going forward.
And that's a very interesting perspective, because I know I've also heard the perspective that gold isn't as much an investment as it is an asset, right? It's something that doesn't produce wealth in itself. It can increase in value during some time periods, but it doesn't produce anything like a company would, right? Your perspective on that, and you mentioned how really for the last 10 years, gold hasn't gone anywhere. And you definitely, if you look at 2011 to now, that's true. However, over the long term, it seems to rise about with inflation. So kind of your perspective on that, is gold an investment or an asset? And isn't it kind of an inflation hedge because over the long term, it does rise?
Well, but I think you have to think about it in terms of sort of the sequence of returns, right? So if we go with the argument that it's an asset, which I don't disagree with, it had a lost decade, just like stocks had a lost decade, right? Meaning it just didn't perform really at all, and actually underperformed inflation, quite a bit. So there are cycles, right, in every single asset class, every single strategy. Most things go up over time, right? It's just a function of where your start and end date is in evaluating that. So it could keep up with inflation. Doesn't necessarily mean it's an inflation hedge, and that's sort of the distinction I'm trying to make with this. But it's like everything else, right? Everything has risk. Nothing is guaranteed. You want to just manage, a portfolio to all of the unknown variables that nobody sees coming, known as the future, right? And size appropriately. So, and to your point about wealth, it's interesting. I was at a conference. This is maybe 15 years ago, and I remember very well somebody said, diversification is a luxury for the rich. And the implication, which is not wrong, is the idea that, if you're trying to get wealthy, if you want to build wealth, you have to take a concentrated bet, right? But of course, there's pitfalls to that, because that concentrated bet could, just like gold the last 10 years, not really do as well as you would have hoped, right? As inflation outpaces you in that moment of time. So again, I look at it more as a diversifier. And by the way, just because gold doesn't produce anything doesn't disqualify it as an investment. Bitcoin doesn't produce anything either. Right, and Bitcoin has made a lot of people wealthy, just like gold has made a lot of people wealthy. Obviously, a different part of the growth cycle, right? But you don't need to necessarily produce something. You need to have enough belief in something to keep it going against a limited supply. I think that's kind of the key.
And when it does come to gold, what is your outlook for it maybe for the next 10 years? Are you bullish?
I always say it's impossible to predict the future, so I tend to shy away a little bit from sort of longer-term prognostications like that. What I will say, though, is that, look, gold has been left for dead for a while. And I get it, right? Because risk on is a lot sexier than risk off, right? Everybody always wants to chase and find the thing which is going up faster, and momentum begets momentum. But again, cycles exist, right? And gold probably is going to have a juncture where, like broader commodities, it'll rise with the general sort of reflationary push that we're seeing economically. And there are going to be a couple of these risk-off junctures. If you go back to the idea that gold is more of a risk-off hedge than anything else, well, you've got 30 trillion or so of U.S. government debt in the system. And I always make this point that when you have this much debt in the system, it doesn't take that many butterflies flapping their wings to create a hurricane, right? So my argument would be that if you look very long-term, the one thing I'm fairly certain about is there's a lot of fragility in the system because there's a lot of leverage. Which means there should be more of these risk-off pulses, more of these volatility junctures, which gold can benefit off of, right? So I'm trying to answer your question by arguing that the path of markets is likely going to be more volatile for many, many years to come, because the starting point of debt is so high and that should at the margin create some demand for gold.
And what about silver? Because a lot of people in our community think that silver is undervalued with respect to gold. I guess when it comes to investing, right, how does it compare to gold in your mind?
Yeah, and I haven't looked at the silver to gold ratio in some time. As you know, right, these things tend to kind of move somewhat lockstep, silver being sort of the poor man's gold, although who knows how long it's going to last if silver keeps doing what it's doing. And if you do have the mythological short squeeze finally really take place in silver, right, then all bets are off. Look, I mean, I think silver is from a signaling perspective more of a tell on industrial growth expectations and activity than gold, right? When you compare silver against gold, or similar to copper to gold, similar kind of dynamic in terms of a signal, right, as far as risk-seeking behavior. So again, I suspect silver, commodities, it's all part of that sort of broader wave towards the asset class. It's unclear to me which one would do better or worse. Right, because again, it just depends on your start and end date. There are going to be plenty of junctures where gold outperforms silver, and plenty more where silver outperforms gold. Given the nature of silver as more of an industrial play, the number of days with which it outperforms gold would probably be more, but the magnitude with which gold can outperform silver, right, in those risk-off periods is probably where it kind of evens out. So I'd say broadly, makes sense to consider silver, as part of that trade.
So that's very interesting. Essentially what you're saying is that during these times when silver is needed for industry, for example, if there's a greater push for green energy, silver might outperform. But in times where there's a lot of risk and volatility in investors' minds, right, that then they'll move to gold, and gold will outperform silver. Yeah,
it's fine. I never kind of made this analogy before, but I think there's some truth to it. If you think about what's the defensive part of the stock market from a sector perspective, it's utilities. What's the most defensive part of the commodity market? It's probably gold.
And with respect to the volatility and risk, it seems like the system right now is very fragile, as you mentioned. And when it comes to the stock market, your perspective on that, we've been rising for so long and people are thinking that this is a bubble and it could crash. Your perspective?
Look, the what happened earlier this year with GameStop and Reddit and Robinhood, and what happened with this Archegos, family office deleveraging, yes, they were momentary blips and the market came right back. But in the moment, there was some real fear of systemic risk around Robinhood no longer existing because of this one silly stock, because of memes. If you take a step back and you say to yourself, wow, I mean, you go from, a housing crisis, something which affected everybody, to now a single stock and a short squeeze maybe bringing down the entire system. You have to kind of take a step back and say to yourself, something's really off here, right, in terms of, again, the fragility of markets. Now, I always make it a point that when you think about crashes, right, you don't know the exact mile marker that you're going to crash, but you have to be on the lookout for the conditions that might favor it. Right now, I'm known for these different white papers that have won these different awards that document leading indicators to conditions that favor the weather. Lumber relative to gold is one of those. Right? So talk about gold as a defensive play. Lumber is more of an offensive play, right? And lumber has been vertical, this year, which makes sense because there's been a lot of demand for housing. Sawmills are offline, and you just don't have the availability of 2x4s like you did before. And so lumber substantially outperformed gold, and all that is more suggestive of a risk-on environment. But the move is also too extreme. And if gold is, as I suspect, going to have its day in the sun, and lumber starts to mean revert on the downside, that would be a risk-off signal, which would suggest it's rating, which means the odds are higher of a crash. Again, you don't know exactly when, right? It's like every time you drive, you slow down entering a storm, you don't know which storm is the one where you slowed down, and that's the one that saved your life, that action, right? So I go back to, I think the risks are there, and I do think in general, I talk to a lot of advisors, and I talk to a lot of high net worth investors every day, and I run mutual fund and ETF RORO that are risk on, risk off in their approach. And it seems to me that almost nobody's hedged. I mean, and you can see that with put call ratios. You can see that in terms of even the sentiment around the bull move here. No one seems to be of the opinion that you can ever decline. Usually when that's the case, from a sentiment perspective, again, I go back to the conditions are there. So again, what does this mean from a portfolio perspective, right? If you're worried about, a large decline coming, you want to have less correlation in a portfolio, which means less exposure to equities, maybe more exposure to diversifiers like gold, on the hopes that if a crash happens, at least you're not going to get, your head chopped off during it.
Now, when it comes to this market volatility and this really the market just being so fragile, maybe we can take a step back and ask, how did we get here? I mean, one of the things that I just think is very unusual, really since 2008, the Federal Reserve has been expanding the monetary base at a very high rate, right? We started at 900 billion in 2008 and now we're at 7 trillion. I mean, this is unprecedented. There are things that are happening today that are completely unprecedented. Your take on how we got to this system that is so fragile?
Well, if you go with the idea that fragility is being caused by debt, then who's the enabler? We know who the enabler is. It's the Fed and the politicians, right? And I think this is sort of the perspective I have on this is that, and I've asked this question a few times on Twitter as well at Lead Lag Report. Look, discipline is needed if you're going to have a system that is not based on a gold standard. Right, you need to have politicians that will, when they raise taxes, won't think about spending more, which is the case now. They'll think about actually paying off the prior debt. You don't have that, and when you're off of a something like a gold standard or something that is tied to a set supply of monetary value, the problem is there's constant incentive to want to leverage up more, to promise more, because that's how you get elected. So you have ongoing debt created by policymakers who are giving freebies, right? And every single iteration, every single round. Okay, so debt keeps ballooning. Debt is deflationary. Well, now you have a crisis. And now the debt is still there, but your assets have shrunk. What does the Fed have to do? Lower rates. They have to encourage more debt, right? So you end up having this kind of nasty cycle where, because of a lack of discipline by our policymakers, and by the way, it's not a Democrat or Republican thing. Both parties have been terrible at being fiduciaries to taxpayer capital. Right. When you kind of think about it from that perspective, and the Fed is again enabling this incredible amount of spending and debt to take place, it's only a matter of time until this thing breaks. Now, some will argue that debt doesn't matter, right? The sort of modern monetary theory argument that we're just paying ourselves, the Fed is monetizing the debt, so who cares? Well, I find that very naive in a lot of ways, because if debt doesn't matter, one, why is anybody paying taxes? And I've said that many times before on Twitter and in media appearances. You can say it's to control inflation. Well, I thought they wanted inflation, right? So that argument doesn't make sense. And then I don't know. It's a very strange concept to me that debt doesn't matter when the reality is debt on the government level and all this kind of interest rate suppression arguably is what's caused the wealth gap to keep widening. I mean, so you can argue that, yeah, we can't technically default because we just are paying ourselves back, assuming we hold the reserve currency status. But I'm pretty sure you're going to have more and more people protesting because a lot of societal ills come from a disparity between very rich and very poor, right, on a relative basis. So, in short, it kind of goes to this bigger question, which I always myself kind of pontificate over or think about, can democracy and capitalism coexist if you have a monetary system which is based on trust, and the only thing you can trust is that politicians will keep spending more?
I think that's a very good question. And you mentioned at the beginning where you said what's needed is discipline, right? And how can we guarantee that discipline? I think we can't really guarantee that discipline with the policymakers. And so that kind of takes it to the question is, if we can't change the system, then how do we ourselves have discipline? How do we invest in the system that some people might say is undisciplined? Yeah,
I mean, you're hitting on a point I always say, which is that I don't choose the cards I'm dealt. I just choose to play the game. Right. So I can't change it. You can't change it. We can be optimistic and think we can vote people in power. But the reality is, unless there's term limits in Congress, nobody's ever going to have an incentive to change anything. Right. So the only thing for sure, to use that old line, is that nothing's for sure, which means, again, you have to have as much different parts of a portfolio to invest in. And I know it sounds kind of cliche. It's like diversification is the answer. Well, the reality is it is the answer, but most people don't do it correctly. Most people think owning 500 stocks is diversified. Most people think owning one commodity is diversified. No, everything is a part of a portfolio, and everything kind of reacts off of different unknowable futures. The best that we can do is try to have as much exposure to as many unknowable futures as possible. One of them is going to hit probably, right? But you want to try to have that kind of mindset. So gold will just like in risk parity funds, will behave well in certain environments. Treasuries will behave well in certain environments. Stocks will behave well in certain environments. But you want to have a good mix of all of those areas. And it is important to note, right, that oftentimes the best investments are the ones that did the worst in the last cycle. Right, mean aversion is still a very real phenomenon, no matter which investment asset class, whatever you want to call it, is occurring. I always made a point on the road that mean aversion is a concept as old as the Bible. Right, he who is first shall be last, and last first is mean aversion. Right, it's just a concept that's as old as time, going back to gold and commodities. It's probably their time. But again, I go back to there's going to be these implications in terms of boom bust cycles, and you just have to manage and diversify as much as possible through it.
And with respect to that diversification, I think that's really good, is kind of to look at, we don't know what the future is going to hold. So how do we diversify so whatever is ahead, we're still going to be all right? In your perspective, when it comes to diversifying into gold and other assets, like what are ways that people can do that? Because there are a lot of different ways people can invest in gold.
Yeah, and as you know, right, there's ETFs that some have the physical storage, some you might say are questionable in terms of whether they actually have the backing of the underlying commodity, or look, I think a mix of something that's in the market as well as a mix of maybe some physical probably makes some sense, right? Because it's like that's the thing about cryptocurrencies. It sounds impossible, but if you got what do they call an EMP pulse, and all the internet goes down, your cryptocurrency doesn't matter. It's not going to get you food, but a gold bar might, right? So I think diversification is not just about the investments; it's about where you're storing it, your investments, right? So I think from that perspective, it makes sense to consider some physical, in addition to some more traditional ETF structures. And I'm biased because I live in the ETF space. But yeah, I think that's kind of the key, right? Diversification of not just investments, but location is important.
And before we let you go, if we kind of step back and look at the macro picture, one of the big things that's on people's minds right now is inflation. You've said that it's possible we could actually head towards deflation, which is contrary to a lot of what people are thinking. They're looking for inflation.
Yeah, so whenever somebody asks me, do you believe in inflation or deflation, my answer is always yes, because you can't have one without the other, right? So you go back to debt is deflationary. So at some point you have a real deflation scare. What does the Fed do? It tries to reflate. How do they reflate? They do it with more debt. So that creates short-term inflation, but that still creates more debt, which is longer-term deflation. So you end up having this kind of constant cycle back and forth of inflation, deflation, but the deflation bomb gets bigger because, again, nobody has discipline. So the issue here is, what's been a big driver of inflation has not just been the stimulus checks. It's also been cost push inflation from commodities, from the food space. And all that's well and good and forces inflation expectations higher to a point. The problem is if these commodity prices keep going vertically the way they have, it's going to be more disinflationary, more of a deflationary scare. Why am I saying that? Because when commodity prices are gradual, it gives consumers time to prepare. Companies can pass down that cost to the end consumer because it's a gradual move. They expect that the pace is going to continue. And consumers, knowing that it's going to gradually keep increasing, will act accordingly. If the move is too sharp, like we're seeing in lumber prices now, right, which is just vertical as of this conversation, well, then suddenly, you end up hearing stories about how contractors are slow playing homeowners because they don't want to have to do construction with lumber prices so high. We have people that are saying, you know what, I'm going to hold off on doing my wooden fence fix, right? So because it's just too fast, and consumers and companies can't react quickly enough to pass it, down, right? So that's where margins get squeezed. So I think we may be at a point now where that's actually a legitimate risk, right? Now, that's not at odds with the commodity cycle argument. It's just an argument, for the boom and bust cycle, where the move may be too sharp. You have to correct price, and then you resume. But you've got to kind of let this kind of play out a little bit over time. This is, I think, especially in the housing market and the lumber space and copper too, but more so lumber, it's getting to be a point where it's going to have a negative impact on growth.
So what you're saying is price can spike too much. We can almost have too much inflation right away, and then that actually cuts demand away because people are like, we can't pay this much. So it actually hurts the economy, which causes deflation. Is that what you're saying?
Exactly right. So a more gradual move is what would be sort of more persistent inflationary pressure. The way this is playing out, and that's why I may argue. It's funny. Maybe the Fed may end up being right that it's all transitory, maybe not. But the speed with which commodities are acting, at least short term, would actually suggest that it's going to be disinflationary, which means the Fed could be right. And by the way, when you look at treasuries and look at yields, long duration treasuries, it looks like they topped out mid-March, despite everyone still talking about inflation. So the bond market is also not necessarily believing that the inflationary pressure is going to persist in the way that absolute yields are acting. I mean, a lot of my work is around intermarket analysis, trying to see if there's consistency in one part of the marketplace with another. Bonds are at significant odds with commodities, right? At least short term, and I think that's a big thing to watch.
And if you can expand on then how you see this impacting gold, because you said it seems like the commodities, it's still bullish for commodities, even if we see a little bit of a deflation. Could it be that it's not, again, like you said at the beginning of this interview, it's not so much about inflation, deflation for gold, it's about risk. So how will gold in your mind play out in this deflationary scenario?
Right, and the connection is that typically risk-off periods of high volatility in stocks coincide with deflationary scares. Right, so it's not that it's necessarily correlated to deflation. It's just that deflation can create a scare, which creates volatility, which benefits gold. So I think that's probably the likely scenario where, if you get this disinflation deflation pulse, which is a very unpopular opinion, stocks probably go down. You have a corrective environment for all risk assets. Gold probably benefits at the margin from that.
All right. Well, Michael Gayed, thank you so much for joining us today. Before we let you go, if people are interested in hearing more of these interviews, they can go to libertyandfinance.com, sign up for the free newsletter, and you'll be notified of all the new interviews coming out. And also you can just hit the subscribe button here on YouTube and the bell icon to be notified of all the new interviews we're doing. If people would like to find you, Michael, where can they find you? And any last thoughts you'd like to add? Yeah,
I mean, primarily on Twitter at Lead Lag Reports. And if you're curious about the funds I run, it's at atacfunds.com. Look, the final thought I'll say is that I always use this line on Twitter: opportunity always exists when the crowd thinks it knows an unknowable future. Everyone seems to be very one-sided in their belief about the way asset markets are going to play out. Oftentimes when that's the case, the payout is betting against the crowd. So, I think keeping that, in the back of your mind is important, because humility is ultimately how you end up winning more than everybody else, I think.
Definitely. We definitely don't know what the future is, but I just really appreciate you sharing your insights and really sharing with the viewers some insights about, how do we plan for an unpredictable future? So once again, Michael, thank you so much for your time, and God bless.
Thank you. My pleasure.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price, with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. Call me directly at 419-819-9209, or my sons and fellow brokers at 310-562-6400 or 419-490-5295, or email us, kaiser@milesfranklin.com.